Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today on the EIA show, because remember it flipped because of Labor Day, we're going to discuss in our normal 3 segments, and we want to look at what is happening on a broad global view, but also looking at what's happening in the U.S. There was builds across the board, but what does that matter? Is it something where are we supposed to get builds and it's just a matter of the rate of change? And that's really the case, is we're coming into shoulder period. So we're coming into the shoulder season. This is usually when you start getting builds. The question is, how quickly are they coming, and is it enough to make sure that we're in a good position as we head into the winter months? More of that on the distillate side than anything else. Then we're going to drill in a bit more and discuss on the second segment, looking at refined products and how things are shaping up as we go into the shoulder season, and what do we expect to happen as we head into winter. And then we're going to round it out with looking at the global markets. Saudi cut its OSPs, or official selling price, following the comments about the disconnect between financial and physical markets. And we also want to look at the gasoline crack, which has gone negative in parts, and how it is really faltering, and what is that going to do to distillate production and underlying crude demand when you start looking at refiners and how they're trying to manage the crack spread. So we're going to kick off with looking at Chinese crude imports. And here you can see crude imports were at 9.54 million barrels per day in August versus 8.83 million in July. But when you put that against where we were in August of last year, we were at about 10.53 million. So about 1 million barrels a day less than it was in 2021. Now, there's a lot of things that are continuing to shift. We're going to talk more about this in segment 3, but there's been renewed lockdowns. So we have more lockdowns that have come through. We've also had a bigger push to stop the autumn festival. So that is typically the second largest holiday in terms of against Lunar New Year. So Lunar New Year is the biggest. The autumn festival is the second largest. So there's lockdowns that are really starting to ramp up ahead of that, because this is the broadest that Omicron has been. As we talked in the EIA, in the Econ show, there's a lot of different variants. It continues to grow, and they still have that zero COVID policy. So that is really hindering a lot of that activity. Now, one of the things that I was asked to do was to talk a bit about what does it mean with the price cap that is being discussed by the G7. And I think it's a good point to talk about it, because I'm gonna reference it throughout the other 3 segments. So when you look at the price cap, you have to think about, right now there's sanctions on Russian crude. There's a pushback on it. If you remember, Shell bought crude from Russia prior to it becoming official, and then they got shamed for doing it. That forced them to, the money that they made, they then donated to charity. So right now there is a lot of pressure to not buy Russian crude. So there's that being held back. Now, this was approved by the G7, but it still has to be approved by the EU 27. Now, based on the rules of the EU, all 27 countries have to approve it. And then internationally, countries can opt in or technically opt out of the cap. Now, the interesting thing with the sanctions right now is nobody wants to touch the crude in any meaningful way. It's obviously being moved about. But when you start putting a cap, then you essentially say, okay, well, that is now legitimate. You can now legitimately buy that Russian crude, and they may set the cap at whatever price. The problem or hindrance with, or the only way to really slow down the buying of crude in a lot of these assets is insurance and ship availability. So if you legitimize crude from Russia, well, you now make it okay to get insurance and to get tankers. It doesn't mean that you will. Some companies may want to avoid the headache altogether, but it opens up the opportunity or the ability to get it. So when you start looking at how the physical markets operate, you can't think of it as a very unified front. It's more of like a bazaar or a souk, as we've seen it discussed on Twitter, where you have one buyer, one seller, and they're doing a transaction between the two. Now, that is not that type of transaction that it could be unique to both the buyer and the seller. It may have a uniform contract, but there's stipulations within it because every contract can be slightly different. And it's not like when you look at the financial markets where there's a governing body, there's a clear exchange, there's buyers and sellers, there's dark pools, obviously, but most of the time you can see who's trading what, where the flows are going, where open interest is. It's not the same in the physical world. It's more opaque. And it's not something where it's like, oh, well, Shell got this, so clearly I can, me as representing Exxon can get the same thing. Well, no, they might have given some sort of benefit or kicker to it, and Exxon may not be aware of it, and that's why they got the deal that looked so good. But really, if you go through the details, and those details don't have to be made public. When you look at the details of a deal, especially if you're looking at a deal between Nigeria and China, Angola and China, they don't have to tell anyone anything. And especially given the nature of both of those governments, why would you want to give up some sort of inside look? So again, when you're looking at enforcing a cap, it becomes very difficult. When you look at the cheating that has happened on the physical front, now you're asking people or tempting people to cheat on a financial front. Now, people cheat in things that are very well regulated. So now you're going to take something that isn't very well regulated and you're going to open up the opportunity. So here are some quick, 2 ways that you could do it. Well, you've created the option where it's now available. So, but by creating the legitimate nature of the crude, now you can have additional buyers. So as additional buyers go up, well, then the price is going to go up for India and China. They're still going to pay at a discount because there's still going to be hair on Russian crude, obviously, but it's going to start driving prices up. But if you want to compete, so how are you going to do that? So Russia has said, we won't participate with anybody that goes into the cap. Okay. Well, they could go into the background and say, well, look, we have to do the cap for political reasons. So we're going to pay you the cap rate from this account. But in this mystery account, we're going to pay you the difference that is being charged in the open market. And there are ways to structure that. Does it have to be paid in specific dollars? When you look at the amount of money that has been fined in the trillions of dollars for getting around Iranian sanctions, whether it was by accident or on purpose, there's a lot of ways to do it. And then let's take another example. So now that the Russian crude has been legitimized, Saudi Arabia could say, well, I can buy their crude at a discount, and then I can increase the exports of my crude. So I can take Russian crude, put that in my refiner, take the oil that is now kicked out of the refiner, I can then send that to Europe. So essentially, they are enabled to absorb some of this and export. Again, these are just some examples. I'm not saying they will happen. I'm just saying that they can happen, and there's a lot of ways to do it. And again, the physical market is very malleable, and as someone who has been in that market, there are very shady cast of characters that will operate within it and will walk that line on the right and wrong side of legality when you're looking at some of these things. So again, there's a lot of ways to get around this. It's happening with LNG. Quick example here, Russia's trying to find places to put their Yamal cargoes that are no longer coming to Western Europe. India is saying, look, we'd be interested in working out a deal. They can get discounted LNG, but they're still going to be pulling LNG from the US under the different contracts. So they are looking at this and saying, well, we can buy cheap LNG from Russia, or discounted, not so much, cheap, but discounted LNG from Russia. We can then take the cargoes from the US that don't have a destination clause, and we can just resell it into Europe at a premium. So they get discounted LNG in-house, and then they make the difference, or a margin, or a nice ARB, going from the US into Europe. So again, there's going to be ways that this is going to kind of rejigger the map. It's going to, and all of this leads to the same thing: an increase in miles per ton. So there's going to be ways around it. It's going to have a longer distance. So there's going to be more tankers used. There's going to be more, fuel, bunker fuel burned. And you're going to see a lot of these shifts as countries try to adjust. Now, the biggest hindrance is going to be Hungary. Hungary has been has pushed back on a lot of different initiatives that have gone to trying to put sanctions on Russia because they need that crude. They need that optionality. But there will be something done. What that looks like at the end is unlikely because the cap would replace and again, this is just what you opt in on, the cap would replace the ban. And so if you get that reversal, well, that now that you start to open up things. Now, there are countries that will opt out of the cap, keeping the ban, but these are where things can get very interesting. And again, it's always going to come down to, can the country get or the ship get insurance? Can they get the ship to move it? And those are going to be the biggest pieces. And if you have the legitimacy, you'll be able to do it. So when you start looking at this, Russia expects to maintain current oil production of about 10 million barrels per day. So again, when you think about the OPEC cut of 100,000 barrels, technically Russia can produce 11 million barrels a day. Well, they're already a million below. So when you start looking at that OPEC cut, again, it's essentially meaningless because nobody's producing at the new level for October. So it's not like we're going to get a huge amount coming out of the market. Russia expects Urals prices to be within the range of 70 to 90 barrels, $70 to $90 a barrel in the foreseeable future. And just based on buyers in the market, so far that looks likely. But if China stays at these levels, it's unlikely you're going to get a huge tick up. India, on the other hand, so India says Russian oil now accounts for 12% of its overall purchase of the commodity, with the ratio surging sixfold in the past few months. And they ramped up from 2% to 12% just based on those prices. And right now, China's economy is obviously struggling. We've talked about it. India is still doing fairly well. So when you look at where a lot of those cargoes are going to end up, it's going to be in India and not so much in China, which will weigh on prices. So we would say it's on the lower end of that. But again, these are some of the things that we've been talking about, and it'll be interesting to see how it goes and develops. So now when we start looking at total oil product stockpiles, here you can see that the deficit widened from 39.7 to 54.8. And a lot of that was driven based on the land and floating side. So the surplus narrowed on the crude front from 13.4 to 0.6. And a lot of that was driven by the floating front because you had a lot of cargoes going from floating storage into transit. So you get this backdrop in terms of where things are and some of those different disconnects. Total oil product stockpiles. When you look at the products in general, the deficit widened from minus 53 to 55.3. But when you look at the charts in general, where they fall in the cloud, total oil product and stockpiles, they're still on the lower end, but you can see that there's that normal drift down. Especially in 2021, you had that movement lower, but you can see that there's that thinning out as you get, obviously, the slower period. So the comps keep getting easier as we progress. And then when you look at the crude front, the surplus is still in the market, and it's above where we were in the 2017 to 2019 range. And when you look at the U.S., which this doesn't account for, we had a build today, and then we're starting to see some of those builds with a little bit more floating storage out there in the U.S. Exports are going to remain very robust as they continue to flow into Europe to replace Russian barrels. And then the stockpiles can, again, remain at a bullish backdrop, but all things are not equal, with gasoline the overhang, distillate the underlying problem. So a South Korean origin gasoline cargoes coming into California. California is trying to replenish some of their drops. Phillips 66 is a charter and operates the refinery in Rodeo. So they're trying to bring some of that in. European gasoline laden tanker that arrived in New York made a U-turn and is now going to West Africa. Because when you look at what Europe is trying to do, they're trying to dump a lot of this gasoline into the market. And this comes on the back of a big spike in arrivals into the U.S., with coming in at 376,000 barrels per day, the highest since early July. And this is what we were talking about. We saw it coming. It's now starting to come through. And we see it will drop off because a lot of this is seasonal. We normally get a decent increase in imports of gasoline right before Labor Day and then right after. So it's just going to be a matter of what does that look like as we go forward, as things rebuild. Land storage total deficit widened from 53.5 to 57.5. West of Suez, it widened slightly from 32.5 to 33.6. And then east of Suez, deficit widened from 24.2 to 27.1. When you look at west of Suez, tracking fairly close to where we were in 2021, we will leapfrog that at this point and go just above. But again, we're still on the lower end of that, and especially when you look at the land storage, the question is going to be where is a lot of this coming from when you start looking at the storage on the floating storage side. So you can see here that floating storage normally drops this time of year. When you look at 2016 to 2019, we normally see that movement coming through, things coming off the water. The surplus narrowed from 37.4 to 36.9. And then when you look at the west of Suez, it flipped to a deficit from positive 0.7 to negative 3.2. And a lot of that was from West Africa, which has seen, again, more of that crude get kicked to sale as they continue to cut differentials to push that through. East of Suez, the surplus narrowed from 36.2 to 35.8 and will continue to be fairly flat. When we look at crude stocks, in the U.S., we had a build of 8.85 million barrels. We're still 32.1 million below the 5-year, but we're 3.3 million above last year. And that's, I think, some of the interesting pivots when you're looking at where we were versus 2021. We're actually above where we were in 2021. And again, I don't think we stay above it. I think we kind of, as we've been saying, just go sideways. But as the seasonality goes, we normally have some of these builds. We have things that are going to kind of start to play out and average out, which we'll talk about in a minute. But then when you look at Pad 2, small draw of 670,000 barrels. Cushing, same thing, small draw of 500,000 barrels. That's what we've been saying, kind of that marrying of, the small builds, small draws, something fairly stable in Cushing while Pad 2 remains low, 18.9 million below. Pad 3 had a big build of 9.88 million. With that puts us 8.9 million above the 5-year, 13.3 million above year over year. And a lot of that is driven by those imports that we've been waiting for. We've seen them finally hitting the market in terms of the numbers. And then based on floating storage, we should see that still continue. And then when you look at Pad 5, fairly stable. When you factor in the draws from the SPR, the build was only 1.32 million. So again, just looking at some of those different balancing acts as crude production remains flat. And that's something that, again, we see that still at closer to 12.2 million barrels. So when you look at the physical market in general, there's still a lot of that softness, which we continue to see. It's starting to find a bit of a footing given where some of the movements are. But it's just a matter of what does that footing look like? And we do see some support here. The question is, what does the next leg really look like? Pad 3, just looking at that surge. So if you take out 2020, this is the second highest it's been. The two periods, obviously, that were higher was 2020 and 2016. So you can see that we're still above. And here you can see there's normally those draws. And then as you get those draws, then you kind of flatline. And that's what we've been talking about on seasonality. And one of the things that we said from the beginning, if you look at the beginning of the year to now, that Pad 3 was going to be flat, but the market was going to come to you because there's normal draws that happen during the summer months. You normally have that draw period, and then you get this kind of flatlining as you get into September, end of September, October, and then you get some more of those builds. So this is why we've fallen back into a fairly normal level from a Pad 3 perspective. Pad 2, on the other hand, Cushing, on the other hand, you can see still remains at the low end, but fairly balanced at where we were in 2018. It's just we typically have an increase in Cushing as we get to the end of September, and then that accelerates as we go through till about the middle of November. So there's nothing to show that we won't see that. I think the biggest question is going to be, where are exports? And if exports continue to be where they are, why go to Cushing when you can go to the export market, which again could keep this on the low end. Then when you look at runs dipped 1.8%. That's a lot of that was still driven by Pad 2, which had a drop of 384,000 barrels a day. And remember, we were talking about some of the issues when you're looking at when was BP Whiting, the big drop, going to be recognized. And a lot of that is here, which has now come back to normal for the most part. So you should see some of that reversal, but not a huge reversal. It's not like on the refining utilization rate, we're going to 95%. It's just we're going to stay around this 91, 92%. But as we get towards the middle of September, we have more refiners going into maintenance. So again, any kind of bounce will be short-lived as we're in the downslope when you're looking at the underlying utilization, which, as you can see here, it normally happens, as we said, as we get into the middle of September. You hit the trough, let's call it middle of October, end of October, and then you start to see refiners ramping back up as we get into the winter months. Imports spiked a nice increase of 825,000 barrels a day. And this is just a lot of things culminating at the same time. You had the big increase in Pad 3 of 41,000 barrels a day. Pad 2, as we were saying, was going to have that spike up 218,000 barrels a day, with Pad 1 having another nice increase, with Pad 5 being fairly flat. Again, Pad 5 is the lumpy one. Pad 2 is going to remain elevated, and we should see some staying power in Pad 3. The question is going to be more on timing, but based on what we're seeing in floating storage, there's going to be more that's going to come into that market. And here's that example that we were talking about. We've been saying that we were going to see a new 2022 high of imports, and we got it. It's obviously counter seasonal, so it's not like we're above the 5-year average in Pad 3, but a lot of that is weather driven based on some of that drawdown, as well as just timing. So we're still going to stay again at the below the 5-year average, at the middle of that cloud. But we should stay a little bit higher given some of the discounts that came into the West African market, the need for distillate, and get a little bit heavier on the Pad 3 front, especially as we head into the heating oil demand season. Here's that bounce we were saying, again, back above the 5-year average. We expect to average, again, the high end of that cloud as Pad 2 continues to pull down more crude. Implied demand, we had an increase in gasoline of 136,000 barrels a day from 8.59 to 8.7. Again, that's still on the low end, so we should get, based on how low this is versus where we are, we did see Labor Day at about 9.1 to 9.2 million barrels a day. So we should get one more shift up or two, depending on, so here you can see we only went from 8.59 to 8.72. which means that we could get one more spike up to about 8.9 and then, and then drop down and stay at about 8.7, trying to, again, create that catch up. And then we'll start to average out something closer to about 8.5 as we go through the remainder of September. Distillate, again, staying fairly firm. We're coming into the slow period for demand for heating oil. Obviously, heat's not on yet. So we're in that fall season, while diesel and I should say the trucking demand still remains elevated, below where it was obviously last year, but right around where we were in 2018. Jet fuel had that correction to the downside after that last surge for Labor Day. Now we're coming into that fairly slower period as we go through the fall months. And then when you look at propane, an increase of 424,000 barrels a day. And that should start to creep higher as we get into harvest, because propane is used for crop drying. So that's going to be one that's going to have a bit of a tailwind. And this just gives you an idea of how low implied demand is. We did expect it to get that bounce. The problem is the timing of the bounce. And you can see how those peaks don't really match up, because it depends on where the holiday falls in terms of where this is reported on this chart. So here there will be that spike. It's going to be a bit muted just because the high end in 2021 was about 9.6, 9.7. So to get it, for us the peak was about 9.1. 9.2. We had it slightly below the peak of about 9.3 for July 4th. And now you can see you had that spike, then you have that drop down, and then you kind of stabilize at that lower level, and we don't see that being any different. Crude oil inventories, excluding SPR, here you can see we're moving back up. And remember, as we've been saying, the comps get easier. You normally have that drawdown through the summer months, and now instead, as we said was going to happen, we just went sideways. And as we went sideways, that's where you start to see things kind of falling back into a bit more of a normal backdrop across the U.S. crude front. Days of supply dipped, but this is a week delay, so we will get an increase as we did get a build and we did get utilization rates coming down. Then when you look at total crude and products, again, flat. That we don't see much adjustment, but you can see that drift lower. So even though we still remain on the lower end, driven by the distillate side, it's not as bad as it was because you did get some comfort from gasoline. Crude has been fairly flat as the seasonality works in your favor. Well, it depends on if you're bull or bear. Starts to come down closer to where we are today. So then when you look at gasoline storage, as we were saying, going flat, just not seeing too much pull down because we did get a surge of imports. We still are on the low end of demand. And that's, again, that supporting side as you normally have that demand coming down and the storage coming down, things get a bit more normal on that front. Again, seasonality, where distillate, we're going sideways, but we should be building. So again, things are getting worse. So things are getting better on the gasoline side against the 5-year average of what normally happens, while distillate going sideways, things are getting worse. So again, you see a lot of these different disconnects. Jet fuel, again, is just fairly stable. We don't see much happening here. If anything, it'll probably grind a bit higher. But you can have kerosene or you can have distillate. And given where the distillate side is, there's a lot of reasons to keep this as low as possible, maximizing the disti pool. When you look at the crude curve, everything is shifting down. You're seeing more of a flatlining. That is likely going to continue because when you start looking at the flip, and again, you're obviously still in backwardation, but do we start to get some contango creep if you see some of the shifts in demand where now we want to incentivize a bit more storage versus backwardation? Because right now you're going to try to sell as much as you can right now at today. Contango, you're getting paid to keep it on the water a bit longer. So do we start to see some of that flip? I don't think so yet. I think it's still too early. But as we get deeper into shoulder season, that you could see a bit of that creep into the curve where it's going to make a bit more sense. Because when you look at it, you're starting to get a little bit of a flatlining, still in the backwardation front. But I wouldn't surprise me to see a bit of contango come in, barring obviously anything crazy, in the next few weeks, as crude in floating storage remains a bit elevated, right in around the average side. But again, it's just a matter of that timing. We do expect to see floating storage hold in a bit steady. The question is going to be, when did we get some of that pass through? So here you can see that we have some of that remaining. Now, that's what we have for you here. In the next segment, we're going to go deeper into what is happening on the refining front, and especially on refined products in the U.S.